So the first 5 units of this course constitute what we call financial accounting. So after learning through all the concepts and principles from units 1, 2, 3, and 4, finally in unit 5, we consummate everything by producing what we call final account. So we're going to look at 2 questions, one from this pamphlet, and the other one from last year's paper, which was question 1. So this exam is a composition of financial accounting and management accounting. So we're done with financial accounting, so this is just a climax of this course. We go to the management accounting part. So we're given a trial balance. A trial balance is simply a list of balances. Now, a trial balance has adjustments at the far end. These adjustments are mainly used when we want to prepare the income statement and the statement of the financial position, which we also call the balance sheet. So we're going to now look at the adjustments, and then we're going to tailor the adjustments to balancing the whole balance sheet. So we know using our error rule to say what is on the debit and what is on the credit, to follow this kind of arrangement. So all purchases, all expenses, all assets have what we call a debit balance. All revenues or capital, all liabilities, all sales have what we call a credit balance. So to increase them, we credit them. To reduce them, we debit them. Similarly, the purchases, expenses, assets, to increase them, we debit them. To decrease them, we debit them. We credit them. Basically, that is what the balance sheet shows. It's a list of balances. So the bank is on the debit side. If it was on the credit side, we would have called it an overdraft. All right, share capital is a revenue. On the credit side, we have cash, the 2,400. We also have a long-term loan, which is 15,000. It is a what? A liability. Insurance, fixed, and expenses, these are expenses. And fittings and fixtures, these are assets. And accumulated depreciation, we have 10,000 there. Provision for doubtful debts, we have 5,000. Purchases have a balance. Purchases returns are supposed to be on the credit. Salaries are expenses on the debit side. Sales are on the credit, meaning sales returns, debit. The stock that we have in this important book is called our opening stock. What is in the adjustments is what we call the closing stock. Account payable is called a debtor, creditor. Okay. And account receivable is called a debtor. So a trial balance also balances. So these figures are there. It's imperative also to know where you can post these accounts where they belong. So I need to do a simple, quick exercise. You tell me where we're going to take it, whether it is in the income statement or in the balance sheet. So let's go quickly. The bank, how are we going to post this?
Balance sheet.
Balance sheet as a what?
As an asset.
Current asset, correct. Share capital.
Statement of comprehensive income.
Try again.
It will be the statement of comprehensive income.
Try again. The balance sheet. Okay. Quickly, was at the far end there. Remember, the balance sheet has equation. Capital is equal to assets plus liabilities. How about the long-term loan? Long-term loan, where does it go?
Balance sheet. So share capital is not equity.
Share capital is equity. It goes in the balance sheet. It doesn't go into the income statement.
Oh, okay.
So, how about cash? Does cash go?
Balance sheet.
As what?
Current assets.
As a current asset, correct. But insurance?
Also balance sheet.
Insurance, again?
It's an expense.
Because income statement as an expense.
Good. Income statement as an expense. How about office expenses?
Also expenses, income statement.
Income statement as an expense, correct. How about fittings and fixtures?
An asset.
Balance sheet,
Balance sheet as a what?
fixed asset,
As a fixed asset, correct. Accumulated depreciation?
income statement,
Again? It's accumulated. It means it came from last year. It was already treated in the income statement. So this one will go to the balance sheet. But the one in the adjustments, if there's any, is one that goes to the income statement for this year. When it says accumulated, it means it's already been dealt with. Purchases?
Balance sheet.
You're now guessing. How about provision for doubtful debts?
It goes in the income statement.
Yes.
Even purchases,
Yes.
income statement, salaries,
Salaries, income statement as what?
expenses,
Expense, okay. Sales?
income statement.
And the trading account. This one is the trading account. The trading account is the top part of the what? Of the income statement. What? Opening stock?
Income statement.
Income statement under the trading account. Debtors? Creditors?
Income statement.
Balance sheet. So creditor is what? Current liability.
Also that one, balance sheet.
Doing this one, balance sheet as what? Current asset. I'm glad at least you're able to identify. Then we have adjustments that need treatments. So we have closing stock, 30th March, 8,000. Where does this go?
The income statement.
as in the balance sheet.
Balance sheet as a what?
As an asset.
Current asset, correct. About included in the expenses, we had 5,000 relating to month of 2020. This I thought is for which year? At March 2020. So April is the March, April, following month. So what is this? Is it an accrual or prepayment? They're saying in this amount of
Prepayment.
insurance is a 500, which belongs to the month of April. But our month ends where? March. So what do we call this? Prepayment. So prepayment is the what? The money, the current asset. So this treatment will appear in both. How in both? Income statement, what we do? Income statement is the prepayment. less prepayments. Always according to the matching concept, we haven't enjoyed those on our money, we less it, we don't charge it. And then balance sheet, we show it under current assets as a prepayment, so our money. Together? According to the accruals concept, whenever you have money that is paid, which it does not belong to that financial year, don't charge it for that year. It will understate your profits, thereby you pay less tax. So you subtract it from the income statement. You add it to the balance sheet as your money. If any people came, we'll still go and claim that, I know this is money we paid in advance. That's why it's called a current asset. Is that clear? Depreciation on cost, 10%. Depreciation calculated as an expense. This one appears in both the balance sheet and the income statement. So 10% will be on the cost value. So the cost is 30,000. But when you are taking it to the balance sheet, 10% of the 30 is what? 3,000. So we'll add 3,000 to this accumulated depreciation for the following year. In the balance sheet to be 10,000 in total accumulated. Since it accumulates, it will become 10,000 has been accumulating from the previous years. So for this year, our only charge is what? 3,000. The value of this asset is 30,000 minus 13,000. That is our net book value that we're going to calculate in our balance sheet. Are we together? We are told that 3,000, which is in the data's figure, is a bad debt. So a bad debt would be what? An expense, income statement. So our debtors of 18,000, the 3,000 which is bad debt. So we're going to put subtract 3,000 to get to 5,000. Okay. Then we are also told that the first 250 represents what? Amount or we can accrue water expenses. We didn't pay for water. So according to accruals concept, enjoyed the water already, so we subtract as an accrual. So to appear in both. How in both? Can somebody explain? How does it appear in both?
To appear in both for the income statement, since it's we've gotten the service but we haven't paid for it, so it's an expense under income statement.
Okay.
Yeah, thanks. For the balance sheet, someone else can.
I'm happy the way you're analyzing it. Yes. So it's an accrual. So we enjoyed the water. So according to the accruals concept, you charge it. If you have employees that have worked and you haven't paid them, you pay them either way, you charge them. But under liabilities in the balance sheet, you charge it as current liability because you need to pay them within the year. So this 50 is an accrual, and it is also supposed to be subtracted using the accruals concept. All right, are we getting there? Then the provision for bad and doubtful debts should be increased by 900. So our provision for doubtful debts is showing 5,000. So any increase in doubtful debts is an expense. So the 900 with the provision, but when you're subtracting our debtors figure, we subtract the 5,000, also subtract 900, subtract the 3,000. So we subtract the 3,000 from 3 plus 5, about 8. 8 from the 18, 10,000. 10,000 we subtract the 900. We're going to get 9,100. So this is a figure that we're going to have for debtors that will remain. Okay. So now we're asked to come up with a comprehensive statement in the balance sheet. 11 marks, 14 marks, 25. All right, so how do we go about this? So we formulate our income statement as follows. So the workings that we have are as follows. We know that our balance sheet had adjustment showing the closing stock 10,000. Remember the insurance expenses, the 500 which we paid in advance. So meaning the income statement, you're going to have 1,500, but a payment will go to the balance sheet of not 1,500 plus 500, just a 500 will be the balance sheet. Then fixtures and fittings, we say 30%, 10% is what? Depreciation. So in the income statement, 10% of 30,000 is 3 pin. When we go to the balance sheet, had accumulated depreciation of 10,000. This 3 pin, the total depreciation we're going to have is what? It's going to be 13,000. So the net value for the fittings and fixtures will be what? 30,000 plus 13,000. Calculate how much these assets are worth. Then the bad debts, were told that in that debtors figure of 18,000, have what? 3,000 included, which will not pay. So this one will be as an expense in the income statement. And also we are told that when we remove the 3,000 from there, we don't remain with it. It has figure of 15,000. All right, 15,000. Again, we are told that there's another 5,000 which we need to remove. There's also another 900 which we remove. We'll compute that later on. So we're told that the increase in bad debts was 900. We also told that the provision is 5,000. Together, 900 plus 5,000 will be 9,000. 5,900. So this is what we subtract from the 18,000. Same thing. This is 5,900. Subtract from this. We're going to get 9,100 as the balance for the debtors. We are also given water expenses as 250. So will come as what? The balance sheet as a current liability. Also income statement as what? Expense. So we now go as follows. So our sales figure 93,600. Opening stock. Remember the opening stock we just found in the what? In there as 15,000. So opening stock 15,000. We add purchases 60,000. If there are any carriage inward, you can add them because that is a transport cost for bringing in goods. You can add them. The purchases returns, you can subtract them because that is what? Reducing our purchases. That because they were damaged. But since they're not there, we just add purchases. Then it's a total. Then we less a closing stock. The closing stock was in the adjustments, 8,000. So this is what we call the cost of goods sold or the cost of sales. Less anything paid less, we put it in brackets. When we less from our 93, 26,600. This is what we call our gross profit. Now,
Sorry, Mr. Collins, just a minute.
yes, sir.
Where do you put carriage inwards?
Okay, so there are two types of carriage. There's carriage outwards and carriage inwards. So in accounting, the format we say you can have sales here. Okay, let me use a general format so that you can understand the format in case you're given other things. You have sales here. Any returns, say less sales returns. Okay, then what we get is called what? Sales turnover. Are we together so far at this point?
Yeah.
Everyone is on board? And this is called our
Now following.
turnover. Then we say less cost of sales. This as a title, cost of sales. Cost of sales, we have opening stock. Put it here. Purchases, put it there. Add carriage inwards. Why do we add carriage in? Because the cost of bringing the purchases into the business. Add carriage in. Then we can less purchases returns. What we get there, less closing stock. When we less the closing stock, the figure we're going to get is called what? A cost of goods, or cost of sales. That's where we less now. Cost of sales. Somebody tell me, when less the cost of sales, the figure we get is what? When we less the cost of sales from our sales turnover, what do we call this?
What is the gross profit?
The gross profit, good. The gross profit, you can add other income. If you may have, the income that you may have may be, number one, discount received. You can add it if you have any. You can add interest receivables or rent receivable if you are building the receiving rent, or reduction in bad debts. Now, bad debts are Congolese that you do what you don't expect. So, for instance, you had provided for to have 10% of 10,000, which is your debtors. Say of this debtors 10,000, 10% will not pay us. So 10% of 10,000 is 1,000. Not pay, and you discover that actually only 500 have not paid you. So meaning you have saved a what? You've saved a 500. You had charged yourself to say, well, they will not pay us. So that one is a gain. You add it. But if you say 10% of 10,000, you're expecting 1,000 not to pay you, but instead 1,200 have not paid you. That extra 200 is called an increase in bad debts. So that one is what you're going to charge as an expense, right? So that's the difference between the two. So that's what I wanted to explain.
So, Mr. Collins,
Yes, sir.
so less cost of sales is the same as expenses.
No. We're going to expenses now. Expenses were coming here. This is just a cost of goods sold. After getting the gross profit, we now go to expenses. Expenses were insurance. Remember, insurance was what? It was 2,000. We had an adjustment on insurance at 500 was prepaid. So where is the 1,500 coming from? 1,500 is coming from what? 2,000 minus what? The payment, 500. Office expenses, 15,000. The bad debts and the adjustment to say that it was 3,000. What expenses accrued? So these ones are accrued expenses. We're owing 250. We're adding it. And the salaries, 25,000. The increase in provision, 900. Question: if there was a decrease in provision, where would we take this 900? if the decrease of 900 in provision, where would we take it? We would add it to the gross profit as an income to increase other income. So this is how our profit is calculated. So you can either make a profit or a loss. So depreciation here, we're taught 10%. So 10% of 30,000 was our season fixtures. 10% is 3,000. So when you total these expenses here, we're getting our expenses were 48, whereas our profit was what? 26. So the difference here was 22,055. So this is a loss. So our net loss is 2250. So don't always expect to have a profit. Sometimes you make a loss. Any questions on the income statement at this point? All right, then we go to our balance sheet. Remember, we only have one fixed asset. The fixtures, 8,000, our depreciation, 13,000. When you subtract our net value, which is the net book value, or the fittings and fixtures, is 17,000. Where is the 13,000 coming from? 3,000 plus what? 10,000. Get 13,000. Then we go to our assets that should be always recorded in order of liquidity, starting from the least liquid, the most liquid, which is cash at hand, is 400 cash at bank, which is 1 2. The prepaid what? Insurance. This is our money, 500. Our debtors. Remember the debtors was 18,000. How did we come up with this 9,100? So from the 18,000, we subtracted what? The 900, which is increase in doubtful debts. 1,000, which was what? Provision in doubtful debts, and the 5,000, which was the provision in there. For these, when you subtract them, you get 9,100. So this is where it's coming from. This is a computation. Account receivables, which is our debtors, we less the bad debts, 1,000. We less the total provision, which is the 5,000 plus the 900. It's 9,100. In our closing stock, the stock which comes here is not opening, but the closing stock, which is 8,000. When we total this up, we get our total current asset. Now, you know that in the balance sheet where we fulfill assets plus liabilities is equal to capital. So if you want, we can simply get this figure, the fixed assets. We also add this figure, and we also add our liabilities. Or this is format I'm using here. Then we go to our liabilities.
But before you proceed, does the order here really matter on these items, which you said we start with the list in terms of liquidity? Does it matter since we are adding the figures here?
Not really, but for accountants, I'm just mentioning that usually, if you're a chartered accountant or you are order of liquidity, it's usually like this. You just look improper when you put cash there. You put, all the statements you ever see, cash at hand will be there. You have cash at bank, cash convertibles. That's the order that we use, but you'll not be penalized if you're non-accountant.
All right, thank you.
We got the current liabilities. We have account payable, which is 13,000. The accruals, which is a short-term expense of water, which is 250. We add these two, we have our total current liabilities, which is 13,250. When we subtract them from our assets the current assets, we get our working capital of 5,950. We add this to the fixed assets of 17,000, we get 22,950. We add the long-term loan, long-term liability, which was 15,000. We subtract the long-term liability, sorry, 15,000. We're going to get the closing capital of 7,950. Then we go now to finance by capital. The share capital, which was 30,000, and add our net profit, or we add our net loss. If it's a loss, it's obviously a subtraction. We can also later on list drawings if there are any. If there are no drawings, you just give us the closing figure, which is what? 7,950, which is the same figure, 7,950. It has balanced. However, I'm saying that here we could fulfill capital is equal to assets plus liabilities. If you wanted, you could have said fixtures and fittings. The total was where? Was there. You put the total there. So our current assets, we had our figures here, figures there, the total there, would have put them. So just added them there. And here what we have is our total asset. We get the figure there. And we're done with this part. We got the liabilities. So liabilities were the what? Current liabilities and the long-term liabilities. Total liabilities there, put them there. When we add them there, we also compare them to capital. So we have our reserves, net profit. Figures is still balanced if you use that format to fulfill this accounting equation. So I'd want you to redo this work in your own way. I'll send the paper that they wrote last year so that you look at it, try it on your own. This course is interesting because every entry gives you a mark. So this is 25 full marks. When it balances, you know you are good. All right. Try to do that. Then I'll send pamphlet as well. You try one on the black shoe. This one. The ones who have a copy, 28. Try this one out. The solutions are already in there. See how you can manage on your own. In here for now, unless there are any burning questions.